There was a brand new dividend ETF that was just launched this week, which promises a 15% dividend yield that's paid on a monthly basis to shareholders. What's more is, the investments that are inside of this fund reflect the same holdings of a very famous and successful stock market investor. Today we're going to take a look at the VistaShares Target 15 ACKtivist Distribution ETF, which is ticker ACKY. According to the ETF summary on their website, it says it offers investors a core equity portfolio that generally mirrors the top publicly disclosed holdings of William Ackman's Pershing Square Capital, a prominent hedge fund, while leveraging the experience of the portfolio management team to seek to generate high monthly income. The VistaShares Target 15 ACKtivist Distribution ETF is an actively managed exchange-traded fund that seeks income and, secondarily, long-term capital appreciation. The fund strategy involves two components: investing, directly or indirectly, in a portfolio of equity securities based on the BITA VistaShares Pershing Square Portfolio Top Picks Index, and secondarily, generating income through an options portfolio. Primarily through the fund's income strategies, the fund seeks to achieve an annual income target of 15% distributed monthly. So the goal of this ETF is to copy the portfolio of Bill Ackman, basically holding all of his positions along with his allocations, and then using various option strategies to ensure it pays an annual 15% dividend. According to an interview with the CEO of VistaShares, Adam Patty, on CNBC a couple of days ago, the fund can use a variety of different option strategies. According to Patty, it can go beyond just using covered calls, but it does appear the primary way it will seek to achieve that yield is by using covered calls. If market conditions become unfavorable and they aren't able to meet that 15%, then they can also use index options. Looking into their prospectus, it also says they can use synthetic covered calls, like what Defiance, Roundhill, and YieldMax are famous for. With the synthetic strategy, the fund doesn't actually own the underlying shares of its holdings, but it instead attempts to replicate the share price movements of those holdings using options. But apparently they'll only use synthetic covered calls when they deem it necessary, and people won't exactly know when they'll be using them. I feel like that's something worth noting with this fund. If you're an investor that doesn't like the synthetic strategies that some of these other fund providers use, then that might be a deterrent. Unless you're okay with regularly checking to see if they are using these synthetic covered calls. It comes with an expense ratio of 95 basis points, which is pretty expensive. It's on par with their other funds, and it is actively managed, but it's much higher than almost all the other income ETFs you would see from other option income fund providers like YieldMax and Defiance. During the same CNBC interview, it was said that if they achieve their monthly dividend goal, then any additional income earned from options will be put back into the fund to protect it from NAV erosion. And also, any dividends that are earned from the holdings in its portfolio are also going to be put back into the fund for the purpose of preventing NAV erosion. I kind of have mixed feelings about that. I really don't understand why they wouldn't include the dividends earned from their holdings in their regular monthly payouts, since I'm sure that could mean that part of their dividends would be classified as qualified dividends. I think there's plenty of investors out there who would prefer that instead. It just seems like it could benefit investors more to put those dividends in the monthly distributions and use the excess options earnings alone to prevent NAV erosion. I know I've been criticizing ACKY for a bit up to this point, but there are a couple of things about this ETF that could have potential. Bill Ackman's portfolio has been pretty successful over the years, and sometimes these options ETFs can have much less share price volatility. Let's take a step back and ask, who is Bill Ackman? He's a billionaire hedge fund manager who's achieved a lot of success throughout his finance career. In 2004, he founded Pershing Square Capital Management, a New York-based investment management company, largely with his own money. Today, his company has almost $20 billion worth of assets under management. He's easily one of the most popular investors in recent history, as his current net worth is estimated to be roughly $9.4 billion, according to Forbes. Ackman is well known for being an activist investor, which is someone who invests large sums of money into companies, and then using their large ownership percentage will attempt to influence company decisions like replacing board members and other managerial decisions. This would make him similar to another activist investor, which is Carl Icahn, and the two have actually been bitter rivals for decades at this point. It is hard to find information in terms of how successful Ackman has been over the course of his career, but considering he's amassed so much wealth attests to how successful he's been. It should be noted that Bill no longer considers himself to be an activist investor. He said many times that he's no longer in the business of trying to force companies to make changes. And I feel like that's a good thing for the sake of this ETF. If Bill believed in some cause that you didn't, like if he had another Herbalife type conflict, then that would be a major deterrent. So let's go ahead and check out the holdings inside of this ETF. There's currently only 11 holdings in this entire fund. The largest at roughly 20% is Uber, followed by Brookfield Corporation at 18.35%. And then coming in third, we have Restaurant Brands International, which makes up 10.89% of this fund's holdings. These three holdings alone make up almost half of this ETF. There's also Howard Hughes Holdings, Amazon, Alphabet Classes A and C, Chipotle, Hilton, and Hertz. A bad thing about investing in a fund like ACKY, which mirrors a famous person's portfolio, is understanding why Ackman owns these positions in the first place. You would have to go back and do some research on that if you're interested. But regardless, that's his current portfolio, which VistaShares is nice enough to put together for a modestly large fee. But we can see that ACKY is not a well-diversified ETF. But it's not VistaShares' fault, it's just Ackman doesn't hold a lot of different stocks. So if it's not clear already, if you want to invest in ACKY, then you need to have a significant amount of faith in this guy. So a steady 15% yield does sound great, considering it pays monthly distributions, but what people need to know is that 15% yield that's fixed is fixed to the share price of ACKY. That means that if the share price of this ETF falls, then the dividends are also going to fall with it. It pays out 1.25% of the share price every month, and if it goes down continually, then so will the distributions. There's a perfect example of this because VistaShares does have another similar ETF, which is ticker OMAH. It's basically the same ETF, only it mirrors Warren Buffett's portfolio and not Ackman's. This one started trading at $20 per share, and you can see it's gone down slightly. If we look at its dividend history, we can see the dividends have also gone down with its share price. Another concern I have with these target income ETFs is what do they do if they don't generate the necessary payout through their option strategies? The only way I see it is that they would have to take money out of their NAVs to keep that high dividend, and if that's done way too often, then that's really going to drive down the share price over time. But it's still too early to know if they'll have to do that. It's even too early to tell for the Warren Buffett Target Income ETF. This one only came out a few months ago, and its returns so far have been just okay. In the end, if you're an average investor, I don't see what makes the Bill Ackman ETF more appealing than the Warren Buffett ETF. Bill Ackman is a very famous investor, but he's still nowhere near as famous as Warren Buffett. ACKY would likely only appeal to fans of Bill Ackman, which he has plenty of. And that 15% yield is a bit misleading. There's probably a good number of investors who would look at a fund like this and say to themselves, hey, if I invest $1,000 into this 15% yielding fund, then that means I'm going to get $150 paid to me every year. But in reality, it won't happen if the share price keeps falling. On the flip side, the share price could rise over time and the dividends would go up in that situation. But we haven't observed how these VistaShares Target funds react to both large increases and decreases in market prices yet. But let me know your thoughts and if you would consider ACKY or a different target income ETF. And with that being said, that's going to wrap up today's video. If you'd like to connect with me and see what's inside of my own high-yielding dividend portfolio, then feel free to check me out over on Patreon. You'll be notified when I make trades and you'll get access to our Discord with other high-yielding investors. Thanks again for watching. Please be sure to like this video and subscribe if you want more high-yielding investment content. Thanks again for watching, and I hope you all have a great day.